The world stopped making sense somewhere around $71. That's the number flashing on your screen right now, the comfortable lie that keeps trading desks humming and algorithms churning through their predetermined patterns. But out there in the physical streets of Tokyo, where actual metal changes, hands between people who understand what's coming, the story being written is so different it might as well be happening on another planet. Verified reports from sources deep in the Japanese retail market confirm that silver bars are trading for 20,000 yen, which translates to roughly $130 per ounce when you run the conversion. Let that information settle into your mind for a moment. The gap between what your screen tells you and what reality demands is $59, an 83% premium that shouldn't exist in any functioning market system. This isn't the normal friction of business, the standard markup that dealers need to keep their lights on. When premiums hit 2%, that's Tuesday. When they climb to 5%, demand is heating up. At 10%, you're witnessing a genuine supply squeeze that makes traders nervous. But 83% represents something else entirely. A complete fracture in the mechanism that's supposed to keep global markets connected. The cable linking paper contracts to physical metal has been severed, and what we're watching now is two separate realities drifting further apart with each passing hour. The skeptics will immediately point to taxes and fabrication costs, arguing that Japan has unique circumstances that explain the difference. They'll mention consumption taxes, minting fees, shipping expenses, and insurance costs, trying to build a rational bridge across that $59 canyon. But even if you stack every possible legitimate expense into a pile, you might reach $10 or $15 of justified premium. The remaining $45 is coming from somewhere much darker, from panic and scarcity and the dawning realization among Japanese savers that their currency is losing the war against inflation. They're not buying silver because they love the way it looks on a shelf. They're buying survival, and survival doesn't have a price ceiling when the alternative is watching your life savings dissolve. The spot price represents what you can pay for a contract that settles in cash, a number generated by people who never intend to touch actual metal. The street price represents what you must pay to hold something real in your hands. And right now, those two prices have nothing to do with each other. This divergence proves something crucial about the current market structure. The arbitrage mechanism that should close gaps like this has stopped functioning. In a healthy system, major banks would see this opportunity and pounce immediately. They'd buy every available ounce at $71 in New York, charter flights to Tokyo, pay whatever taxes and fees necessary, and sell at $130 for a guaranteed profit of $30 to $40 per ounce. On 1 million ounces, that's $30 million of free money sitting on the table, the kind of opportunity that banks would normally kill to exploit. Yet the gap remains wide open, day after day, mocking the efficient market hypothesis that academia loves to preach. Why aren't the banks closing this arbitrage? Because they can't. The logistical pipeline connecting industrial bars and Western vaults to retail demand in Asian markets has been shattered. Refining capacity can't convert large bars into small ones fast enough. Secure transport is bottlenecked. Most importantly, the supply in New York isn't as liquid as the official reports suggest. Any attempt to withdraw tens of millions of ounces would trigger alarms and force cash settlements, exposing the truth that the exchange can't actually deliver on all its promises simultaneously. This situation creates what analysts call bifurcation, the splitting of reality into two distinct worlds that operate under completely different rules. In the paper world, silver appears cheap and abundant, tradable with a mouse click, charting patterns that look bearish to technical analysts who think lines on graphs reveal truth. In the physical world, silver is becoming rare and expensive, requiring weeks of waiting for delivery and massive premiums just to secure possession. Everyone watching this market must choose which reality they believe in, which world they want to anchor their wealth to, because the two are heading in opposite directions. History teaches a brutal lesson about these moments. The paper world can maintain its illusion for a remarkably long time, using sophisticated tools and enormous capital to suppress price signals and maintain the appearance of stability. But physics eventually defeats finance. When the physical shortage becomes undeniable, when the vaults actually run empty, the two prices don't meet in some comfortable middle ground. The paper price always chases the physical price upward, forced to acknowledge reality no matter how much the establishment resists. The banks at the center of this storm are bleeding, make no mistake about that. Their short positions on the futures exchange represent enormous potential losses as silver climbs. Rough calculations suggest they're short about 40,000 contracts, which equals 200 million ounces of silver. If the price moves from $71 to $100, that's a $29 loss multiplied by 200 million ounces, generating $6 billion in mark-to-market losses that would destroy a smaller institution overnight. But these aren't small institutions. These are the giants of global finance, the systemically important banks with $300 billion in Tier 1 capital reserves. $6 billion is painful, the kind of hit that ruins quarterly bonuses and triggers internal investigations, but it's not fatal to an organization with that much armor. The real threat isn't the balance sheet damage. These banks have the ultimate safety net in the Federal Reserve, which will provide whatever liquidity is necessary to prevent a major institution from collapsing over a commodity market. What they can't solve with money is a logistics problem. Capital can't create silver bars that don't exist. Checkbooks can't force metal to materialize in vaults that have been drained. The banks can survive a price squeeze because they have deep pockets. They can't survive an inventory squeeze that leaves them unable to deliver physical metal to clients who demand it. The situation gets exponentially worse when you factor in what just happened in China. January 1st marked the implementation of new export regulations that fundamentally rewire how silver flows around the world. The Chinese government now requires licensing for any strategic metal exports, and that licensing is only being granted to massive state-owned refiners, who answer directly to Beijing. The hundreds of smaller private operations that used to feed the global market are now cut off, forced to sell domestically. The official language talks about quality control and proper procedures, but anyone who understands how authoritarian governments operate knows this is a soft ban disguised as bureaucracy. China produces about 3,500 metric tons of silver annually from its mines, but their industrial machine consumes over 6,000 tons each year, creating a deficit of 2,500 tons that must be imported. Their solar panel manufacturing alone, which dominates global production, is growing more silver intensive with each new generation of technology. The latest high-efficiency panels use 50 to 80% more silver per watt than older designs, and Chinese factories are churning these out by the millions. From Beijing's perspective, exporting silver right now would be insane, literally giving away the raw material needed for their strategic industries to foreign competitors. This creates a permanent structural deficit for Western markets. The United States and Europe don't mine enough silver to meet their own industrial demand. They've relied on imports from Mexico, Peru, and China to balance their consumption. Removing China from that equation doesn't just tighten the market, it breaks it. The West must now fight over the remaining supply from Latin American producers, and that competition will drive premiums higher across the board. Mexican miners aren't going to sell to American refiners at $71 when Japanese buyers are offering $130. Money flows to where it's treated best, and commodities follow money. The supply shock is hitting a market that's already running on fumes. The detailed warehouse reports from the Commodity Exchange show registered silver, the category that's actually available for immediate delivery, has fallen to 38 million ounces. To put that in perspective, global silver consumption runs about 3 million ounces per day. The exchange that supposedly sets the price for the entire planet is sitting on less than 2 weeks of supply. If mining stopped tomorrow, or if transport ships couldn't sail, the vaults would be empty in 12 days. The exchange plays word games with these numbers, pointing to total inventory of around 270 million ounces and claiming there's plenty of metal. But that total includes the eligible category, which is silver that meets purity standards and sits in approved vaults but isn't for sale. That metal belongs to private investors who are paying storage fees and watching the chaos unfold. They're not selling at $71 when the physical market in Asia is paying double. The eligible pile is frozen, and the only liquid silver in the system is that rapidly shrinking registered category. This creates a feedback loop that accelerates the drain. When a commodity is artificially suppressed below its true value, economic law dictates that physical supply will be systematically stripped from the market until nothing remains. Smart buyers recognize the opportunity and stand for delivery, removing metal from the exchange, not to crash the system, but because it's the cheapest place on earth to acquire real silver. The banks created this problem through their own price suppression, and now they're watching their vaults get looted through their own mechanism. Industrial buyers are starting to panic as they watch this unfold. Companies that manufacture medical devices, build 5G infrastructure, or produce aerospace components have relied on the spot market for decades, assuming they could always click a button and buy silver at the published price, plus a small premium. That assumption died when China closed the gate. Now these companies are staring at a future where the spot price means nothing, where the only metal available trades at massive premiums in tight physical markets, and where having too much inventory and storage is a minor problem compared to having none at all and watching production lines go dark. This triggers what supply chain experts call precautionary hoarding. When a critical component becomes scarce, businesses stop ordering just what they need and start ordering everything they might need. If they require 10,000 ounces for next month, they'll order 20,000 just to be safe, because storage costs are trivial compared to the catastrophic expense of a factory shutdown. This behavior amplifies shortages in a self-fulfilling prophecy. As soon as one company starts hoarding, every other company must hoard or risk being left with nothing when the music stops. The banks can manipulate paper prices because it's a closed digital system where they control the rules, the margin requirements, and the algorithms. But they cannot manipulate the fact that a defense contractor in Ohio needs actual silver to manufacture guidance systems, and that silver is now locked behind regulatory walls in Shanghai. No amount of financial engineering can print a bar of silver into existence. No amount of capital can force the Chinese government to reverse its export ban. For the first time in decades, the Western financial elite are discovering they're powerless against physical reality. The road ahead won't be a straight vertical line on a chart. The banks have lost control of the long-term direction, but they still control the speed and volatility of the repricing. They know retail traders love leverage, buying call options and futures contracts with thin margins. So they'll engineer violent price swings, crashing silver $5 or $7 in minutes, just to trigger stop losses, and force weak hands to sell at exactly the wrong moment. This process is called running the stops, and it's how they generate the liquidity needed to slowly exit their own poisonous short positions. Expect margin requirements to increase dramatically as silver climbs. When the price hits $80, the exchange will double the cash needed to hold a contract. At $90, they might triple it, claiming they're ensuring market stability while actually pricing out smaller participants. The retail trader who could afford the initial margin suddenly faces a choice between posting enormous additional capital or being forced to liquidate. The banks have the capital to meet these increased requirements. You probably don't, which is exactly the point of the exercise. The likely path forward involves stair-step repricing rather than a rocket launch. Silver will grind up to $80, then chop sideways for months in a boring consolidation that makes people lose interest and sell. Once the weak hands are cleared out, another gap up to 90, followed by another violent shakeout. This pattern of exhaustion is designed to make holding silver feel like a burden rather than an opportunity, to psychologically wear down anyone who isn't absolutely convinced of the thesis. But while the paper price plays these games, the physical reality continues tightening. The 38 million ounces in the registered category keeps ticking down with each passing week. 35 million, 30 million, 25 million. The divergence between paper volatility and physical depletion grows wider until eventually the tension becomes unbearable and something breaks. The target is certainly triple digits this year, probably significantly higher. The banks are currently managing a controlled demolition of their short positions, slowly covering on dips, gradually transitioning from net short to neutral positioning. Once they've cleared their toxic positions and flipped to long, they'll become the biggest bulls in the room, using their media connections to pump price targets and ride the wave up. Banks don't care whether prices are high or low. They only care about being positioned on the winning side, and right now they're stuck on the losing side. The volatility you'll witness this year is simply the sound of them switching teams. The Japanese scenario illustrates the biggest mistake to avoid. And when you see headlines about buyers paying $130, your instinct might be to panic and buy at any price before it goes higher. Resist that completely. Paying 83% premiums isn't investing, it's financial suicide. Those Tokyo buyers aren't sophisticated strategists. They're terrified people watching their currency implode and paying whatever's demanded for perceived safety. You're not price insensitive. You're a strategist who can take advantage of the bizarre situation where the banks are accidentally subsidizing your purchases. The irony is almost comedic. The banks are spending billions to artificially hold the paper price down at $71 to defend their short positions. But in doing so, they're forcing the spot price low, which lets you buy physical metal at that suppressed price plus a modest premium of maybe $8. You're paying $79 for the exact same asset that Japanese buyers are desperately bidding up to $130. You're getting a $50 discount simply by buying in a market where manipulation is still active. This is the trade of the decade. Arbitraging the bank's own fraud against them, stealing value from a system that's trying to deceive you. But this strategy only works with physical metal in your possession. Paper contracts, exchange-traded funds, unallocated pool accounts, these are all traps that will snap shut when the squeeze reaches its conclusion. Unallocated means you don't own specific bars, you own a general claim on a bank's silver pile, making you an unsecured creditor. When that bank runs out of metal or faces insolvency, you won't get silver. You'll get a cash settlement at the manipulated spot price while the real metal trades at triple digits in the physical market. You'll have technically made a profit in currency terms while completely missing the purchasing power explosion that was the entire point of the trade. Taking physical possession removes all counterparty risk. The bar in your safe doesn't care if banks collapse, if exchanges shut down, or if governments ban exports. It remains silver regardless of their failures, immune to their rules, protected from their games. The battle plan is straightforward but requires discipline. Ignore the volatility that's coming. When banks engineer flash crashes to shake people out, don't watch the spot price as a measure of wealth. Watch the number of ounces you control, because ounces are the only scorecard that matters. When manipulation drives the price down, use it as a buying opportunity to lower your cost basis. Watch the registered inventory numbers like they're a countdown clock. because when they drop below 30 million ounces, you'll know the end game is approaching. At that point, stop buying and hold tight. We're witnessing the slow motion collapse of a 40-year price suppression scheme. These cycles don't end quietly with orderly transitions and polite acknowledgments of mistakes. They end with noise, confusion, violence, and rule changes that protect the powerful at the expense of everyone who trusted the system. The banks will fight viciously, they'll break conventions, they'll change margin requirements mid-game, but they cannot manufacture silver from thin air. As long as the vaults keep draining and the physical shortage intensifies, the destination is locked regardless of how chaotic the path becomes. The only question is whether you'll be holding paper promises or physical reality when the dust settles and the new price regime is established.